Hello and welcome to the Activist Fire Drill, a webinar presented by IR Magazine in partnership with Nasdaq Corporate Solutions. I'm Neil Stewart, Editorial Director of IR Magazine, and I'll be your moderator today. This is going to be a short and snappy briefing. We're billing this as just 30 minutes or so. We could go a little longer depending on questions, and at that point we will be taking questions from the audience. You can type them into your webinar platform. We're very pleased to field them. In the audience today, well, around 250 people pre-registered, half of them in the U.S., the rest spread around the world, 15% in the UK, 15% on the continental Europe, and a good contingent from Canada. Nearly 10% of our registrants are from Asia. They are mostly investor relations officers, along with some advisors to companies. And when we asked them, and when they registered, if they're comfortable with the IR playbook, only 24% of the audience said yes, they're comfortable. So that's what we're going to be addressing today. And with me here, three speakers to give us a new take on activism that you may not be used to. Dan Ramito is a specialist in ownership analytics and targeting with Nasdaq, and he's kind of our financial guru here, bringing an understanding of capital allocation and efficiency. And Dan, welcome. Good to talk to you. You were at an activist simulation that we did at a think tank in Palo Alto a few months ago. That had the kind of classic triumvirate of advisors: financial communications, a proxy solicitor, a lawyer. But you have a different role, right?
That's correct, yes. I have a role more on the financial aspect of activism and its foundation on the motivations regarding agency costs.
All right, and your colleague, Jonathan Isle, head of Nasdaq's Special Situation Advisory Program. And John, one of your main focuses is shareholder surveillance, so helping companies monitor activists as they come in, including through kind of shadowy means like derivatives and so on, right, John?
Absolutely, yeah, that's our bread and butter.
All right, and finally, Greg Taxon with Luma Asset Management and Spotlight Advisor. So a fascinating career. A Harvard Law grad, started out at Wachtell Lipton, which is, of course, the firm to defend against activists. Went on to be an investment banker, helped found Glass Lewis in 2003. Sold it, went on to head up activism for the Clinton Group, now Luma, and now IR Magazine has called Greg one of the 5 leaders of the new guard in shareholder activism. Greg, not only are you an activist, but you've actually become playing quite a unique role, being brought in to advise some companies. Is that quite unusual, an activist as a kind of consultant?
I guess it is a little unusual, but it's been a fascinating role to play, and I think nobody understands the guy on the other side of the table like somebody who's sat on the other side of the table. So I think it's been good for both sides.
Very true. Okay, thank you, Greg. So let's get into our topic proper. And the structure of this webinar echoes a report on activism from our winter issue. It's available on irmagazine.com. We'll send all the webinar participants a link later. It's a great piece, and all three of our speakers, Dan, John, and Greg, feature in it, along with an all-star list of other advisors to companies. We've got Wes Hall from Kingsdale, that's one of Bill Ackman's lieutenants. We got Bruce Goldfarb from Okapi Partners, a very popular proxy solicitor with activists. Eric Freelman and Matthew Sherman from Joel Frank, Steve Wolosky, an activist lawyer of choice, an amazing array. In fact, that representation from both sides, kind of the go-to advisors for both companies and corporations, companies and activists, and the fact we have Greg on this webinar, and a webinar targeted IROs, pretty much sums up the 180-degree about face that companies have taken. Just a few years ago, it was all about fighting or defending against activists. Today, the discussion is about really working with them. So, John, maybe you could start us off with a quick overview, a look at the tremendous growth of activism, including a record year in 2015, right?
Sure, yeah. So, 2015 marked the 5th year of what we call present-day shareholder activism. Because, gone are the corporate raider kind of type activists. Now they're regarded as more of a positive enforcer, right, with the intent to unlock shareholder value. So, over the years, what we've seen is pretty much activists right now, they're attempting to speak with as many firms in a given sector as possible in order to get that clear understanding of the industry dynamics and opportunities. They're spreading out their targets like crazy. We're seeing campaigns heavily launched in 6 out of the 10 S&P subsectors year to date in 2015.
All right, now let's take a look at the size of the funds.
Yeah, definitely. According to our data through the third quarter of 2015, we did see an influx of about $3 billion in capital attraction into existing activist funds. We estimate that Tier 1 activists are currently representing about $218 billion in equity assets, which follows an increase of $46 billion in 2014, and actually it's incredible. It's a 109% growth rate since 2011. So, obviously we have to keep in mind that the true total war chests include cash and a number of unreported assets. Overall, we're looking at capital inflows year-over-year change in 2013 of 37%, which is actually the largest out of these 5 years. That continues to suggest, stable war chests across the board.
And a good proportion of these sizable funds, like you've got at least a dozen that are over 10 billion or so, right?
Yeah, absolutely.
All right, and then in terms of the targets, again, we'll just go on to this next slide to get a little bit of a feel for the growing size of activist targets, in a sense, right?
Sure. Yeah, it's interesting because, in some ways, size really has become much less of a factor. The growth and the obviously historical success of activist investors have allowed them to pursue companies so large that honestly they at one point were thought to be unattainable. So, with their firepower and the track record, it allows them to push their agendas really by amassing like a smaller stake around a 1 to 3% range. To name a few, we've seen more recently in Apple, DuPont, and General Electric.
Okay, interesting factors there. So the activist funds themselves are getting bigger and seeking bigger targets, but also they can get more traction with even a small stake. And so again, you can get larger targets. Okay, thanks, John. Well, let's get on now to the meat of the webinar now, and the activist fire drill. Thinking like an activist is the heading here, and luckily we have an activist with us. Now, Greg, you've seen a ton of activist situations. You've advised companies on this, as you mentioned before. How should a company be thinking about its vulnerability to activism? What are some of the first things a company should think about when it considers, is it a target?
Well, I think, for a long time, people worried that they would be a target because of bad stock performance or bad financial performance relative to peers, and obviously those are important markers. But they are not the sum total of things that can attract an activist, and so I would certainly caution against, feeling comfortable if your stock is up or outperforming the market in any given period or year. I think the real measure is the business performing to its potential, or is there a gap between the way it has performed and the way shareholders or others perceive the opportunity for those assets and that business to perform? And you should expect that investors with an activist bent are doing that analysis all the time and trying to figure out whether there's a way to improve the performance of the business, even if it's performing reasonably well already.
What about some governance provisions? One of the things you addressed in the report that we put out is that, do hyper-defensive governance provisions actually make a company more vulnerable, not less?
I don't know. I think so, sort of on the margin. I mean, what I would say about that is you can go too far with defensive provisions, and if you go too far, your shareholder base, your long-standing, well-respected shareholder base will be upset. So they can become, in a funny way, a boomerang. If you adopt every defensive measure under the sun in hopes of, girding up against activist or shareholder input, even the long-term shareholders will look at that and say, well, you're not making yourself accountable enough to shareholders, and it can backfire. So, like everything in life, I suppose, balance is required, and overdoing it is a bad idea. Okay.
It's interesting that, you think about these sorts of factors that might make an activist target a company, and what we're seeing is many boards and executives really trying to be, even calling themselves internal activists and making moves kind of in advance of any activist approaching them, right? I mean, are the pickings getting slimmer for activists in that sense?
I don't think so. Sadly, it's a process of elimination. So there's always companies which are underperforming relative to their potential, and there are always the companies where that gap is the largest, and those are opportunities for activists, and there'll always be companies in that bucket. So I do think boards have taken this to heart and are doing good work on their own. Many boards, of course, always have been doing good work on their own, but increasingly boards are thinking like activists, thinking how they could help create value in ways that perhaps they hadn't thought of previously. But there will always be companies who need a little push, and where an activist can make money by being a catalyst for change.
Okay. Dan Ramito, let's move to you now. And still thinking about a company's vulnerability to activism, you've actually invented a kind of quantitative numbers-based approach to getting a heads up, or a diagnostic, right?
Yeah, I think the genesis of the product originated because traditionally, maybe 2, 3, 4 years ago, we would always mark from the surveillance side an activist coming in the stock, but the frustration was, well, why couldn't you tell me this, 2 or 3 months ago? And the point of surveillance is to give you the retrospective, right, to assess what's happened after it's already happened. So we set out to take more of a proactive measure and identify basically the question, well, how do we give you that heads up? What does that look like? What does a proactive alert look like? So what we set out to do was to identify the common denominators that each of the activist targets looked like, which were what they shared. So we went through roughly 250 cases of activism in North America, and we concentrated on market caps above $1 billion. And we started off very basic. We essentially said, well, what are the common denominators fundamentally that these companies shared? And we went through initially about 45 fundamental characteristics, so everything from margin to free cash flow yield to return on investment capital. And then we kind of locked ourselves in the basement and did our statistical analysis and said, okay, which one of these variables, if any, holds statistical weight? So in other words, can we statistically define the most influential metrics in an activist engagement? And luckily for us, we can. Our analysis proved that there's roughly 18 fundamental characteristics that define, for the most part, an activist target. There's always your exceptions, but our hit rates are usually right around 70 to 75%. And we categorize these in 5 primary categories. And Greg alluded to this in his comments earlier, is we're looking for, is performance in line with perceived potential? So if we look on the following slide, we define perceived potential, quote-unquote perceived potential, as your relative performance versus a given benchmark. So whatever your company may be, we select some benchmarks. Most of the times it's your peers, sector, and it's the overall market. It depends on the nature of your business and also the size. And we see where you lie relative to that particular benchmark. To John's point earlier with the... Go on, I'm sorry.
I was going to say, so this is a quant model, right? But so there are factors that don't come into it that you can't see, aren't there, in terms of vulnerability?
Well, yeah, absolutely. But I think, when you're talking about activism to a large extent, you're also talking about the degree of agency cost. So in other words, just as Greg alluded to, is performance in line with perceived potential? And a lot of the times we can say, okay, given the lag in certain metrics, those agency costs are relatively high. And that's what catches the activist point of view, because essentially this model is intended to just reverse engineer the screening process. Okay.
In fact, a fascinating diagnostic. Just how vulnerable are companies, Dan, once you've looked at this? If you, say, look at the S&P 500, what proportion could be targets?
Yeah, so it was actually pretty fascinating to look at that. When you look at the S&P 500, about only 10% of the constituents are vulnerable. So in other words, we rate companies within that given benchmark from low, moderate to high. I mean, we keep it pretty basic, but it's a comparative scale. So we're not just saying a certain amount of points get you a high rating. It's the top quartile, and that's the threshold. So only about 10% of the S&P gets a high rating, and about 8% of the S&P 400 mid-cap index gets that high rating. The interesting component is where you lie in a moderate rating. We see not the vast majority, but a notable percentage is considered moderate, and we feel that that's the case because there's one or two very influential metrics that investors are happy with, whether that's an above-market yield or below-market cash-to-assets ratio. There's various metrics that have heavier weight within the model to where it kind of gets companies off the hook, so to speak.
Okay. John, come in now and let's talk a little bit about surveillance. I've heard IROs complain to me that, their instincts told them an activist was coming in, but surveillance denied it. And, have activists gotten sneakier, or also is the accuracy of surveillance improving in response?
Yeah, I think you hit the nail on the head there. Since activism has really been top of mind for the past 5 years or so, more so than we saw in the early 2000s and in the 90s, the pitfalls that surveillance analysts may have fallen into in the past, they've really become solid learning experiences, right? And we're constantly analyzing those. So years of experience are paramount when it comes to dealing with activists. And like you said, they've become so much more creative and sophisticated when they amass their stakes that we're constantly going back and analyzing, what worked and what didn't work. So that way we don't make the same mistakes twice. Our overarching goal is to provide the most accurate portrayal of our client shareholder base, and we do that on a daily basis. So surveillance in and of itself aims to eliminate the blind spots that our clients, might have if they didn't have us, in order to prevent, address, or engage with activists.
So we hear about activists using derivative swaps, or at the very least, you building up positions using options. What is the significance of those kinds of means of building stakes?
Sure. You see activists pretty much come into a stock, and they might have a 1 to 3% normal equity stake, but the rest of it that gets them up to that, call it 5-6% stake, is in what we've deemed as these derivative swap agreements or arrangements that are out there. It's another means by which these activists are not only able to bypass regulatory disclosures, but also significantly reduce their risks and exposure by committing less capital, right? So it's cheaper to do. When they do this, it allows them that economic exposure to the targeted company, saying, hey, company, I'm here, kind of thing. But it does not give them the right to vote on it unless those options are actually exercised. So it's very interesting how it's done.
Let's talk now a little bit about the point of view of the mainstream investors, so not the activists, but the mainstream investors, and the company has to think about their sentiment. And Greg, maybe I could ask you to jump in here and give us the activist perspective. For one thing, how do you, when you're looking at a possible target, do you reach out to the large shareholders of the company? How do you make that determination, or is that always part of your due diligence?
Yeah, so let me, I'm going to address that. I want to also just go back to how activists build stakes. I will say that activists are using all sorts of new technology all the time, and so there are, for example, some broker-dealers that allow activists to set up accounts at a bunch of different prime brokers and kind of intermediaries and deposit shares, all over the place in a very sort of anonymous way. There's all sorts of tricks going on, and trying to stay one step ahead of John and his colleagues, for whatever that's worth. In terms of this question, we always talk to our fellow shareholders. We often do so after we have spoken to the company or built our stake, because we don't want to alert other shareholders that an activist is building a stake, and we don't want other shareholders to go to the company too early. There are other activists who take a different approach. So some of the larger funds, I should say, people come out sort of all over the place on this question. Some of them will absolutely call every one of the top 5 or 10 before really making an investment decision at all, and we'll try to get a feeling for kind of where shareholder sentiment is. Other people, like Pershing Square, absolutely will not call. And their view is we've done our work. We're confident in our analysis. We'll take our position, and then we're confident we'll convince other people of our view. So it really varies, and I'd say the two extremes are probably JANA Partners on the one hand, who kind of calls everybody, and Pershing Square, who calls nobody.
And what about this phenomenon of RFAs, or requests for activists? That is, the mainstream investors calling activists? How much does that happen, Greg?
All the time, all the time. And, there's a number of, obviously a number of long-only funds and even hedge funds who have intimate knowledge of companies, have been investors for a long time, know management well, feel like they really understand the assets and the strategy, but who don't have either the mandate or the skill set to be activists themselves. And so on the occasion when they think activism can be useful to unlock value and extend the company's performance, they reach out. There are lots of relationships, as you might imagine, between various activist funds and their brethren in the hedge fund world or the long-only investment world, those relationships get stronger every day.
Yeah, we're also seeing that dynamic in the passive world, right? So it's a lot of our clients say, well, we have this heavy contingent of passive investors, namely the index base, so we might not be as at risk. And I can say that, with State Street, that's the first name that comes to mind, they've come out and blatantly announced that, hey, it's not out of the question for us as a passive investor to reach out to an activist. I think one of the funnier comments I've ever heard is, index investors saying, hey, we kind of have this dog in our portfolio and we think that there's a variety of options or alternatives they can go down or investigate, and for whatever reason management hasn't done that, so they will reach out. So the passive world is kind of getting thrown into the mix in that regard as well. Okay,
Dan, good point. And Dan, let's move on now. We've been talking about vulnerability. Let's start talking about response now. And you've done the kind of diagnostics we talked about earlier with clients. You've come up with recommendations and guided them. So give us some advice for preparing to respond.
Yeah, absolutely. I mean, it goes without saying that this puts an IRO or a CFO or a management team, for that matter, in a really vulnerable position where you have to kind of swallow or digest a pill that's really hard to take. It goes against human nature because you have this team of really smart people saying, hey, we don't care that you've poured your blood and sweat and tears into this company. You're not doing what we think you should be doing. And in some case, it becomes a very public matter. So I think the first step is honestly, as corny as it sounds, is to take a step back and really assess in the most objective manner possible, do these vulnerabilities really exist? Because from my standpoint, we see with a lot of clients that they become extremely defensive, and in some cases rightfully so. Whether it's tenure or just effort, whatever the motivations may be, is I would first of all recommend very cognizant that you don't become defensive, because to some degree that really plays in the activist's hands, because if the activist's motivation is the argument concerning agency costs, well, the activist will say, yeah, of course management wants to keep things the same because their incentives don't align with the best interest of the shareholders. So first and foremost, as simplistic as it sounds, you have to remain objective in your assessment of these vulnerabilities. And then from there, we see that the best practices usually center around getting a response per the scenario. So a lot of times we have clients that exhibit, 2, even sometimes 3 vulnerabilities, and depending on that given scenario, you want to respond to that given scenario, right? It's one thing to say, well, we're vulnerable to activism. Well, what does that mean? That's such a broad, ambiguous term. You want to have a plan around the particular vulnerability that you exude to the market.
Okay, great point. Listen, I want to move briskly on. There's some basic points there, Dan, but I want to get on to getting Greg's point of view on something. And that's, as I said at the top, what we're looking at here is about how to work with activists, not just fight against them. And when you actually form that relationship with the activists, what happens next? And Greg, you've put dozens of people, literally dozens of people onto corporate boards, though rarely yourself, I believe. But I'm curious, what happens when an activist or the activist nominee joins that board? What makes for a good working relationship then?
Well, overwhelmingly, the companies are surprised by how much value those people can bring and how constructive they are, and that they don't have, horns and fangs. It turns out, for the most part, activists try to find value-added board members, people who can bring a new perspective or a different skill set or experience base to the table that's relevant and will help the company. So, we often hear from companies that, they're kind of, shaking in fear that somebody's going to come in and throw all the food on the floor and, make the boardroom, somehow less congenial or less productive. I think that rarely, very, very rarely happens. And I think instead what happens is, boards quickly find out that the activist nominees or the activists themselves are there to be productive, cooperative members of the board and to accomplish things. And so I think people who've been through this experience generally report on the back end that it is not as bad as they anticipated, and so if that's comforting to people, they should know generally these things all kind of work out, and the board's business gets done, and people still get to eat and don't have to eat off the floor.
I've heard similar things, Greg. IRO is reporting that they've had a greater demand for information, more rigor at board level, and other directors kind of joining in and finding that they like this sort of new, more focused approach, for example, to capital allocation and so on. It can be a bit of an adjustment at first, figuring out how to cater to what has previously been an outsider is now an insider, but IROs I've also heard them say that it's proven a beneficial relationship. John, let's move on and talk about some of the activist tactics and trends that we might look out for in 2016 and beyond. And to start with, what do you see happening outside of North America, which has really been the hotbed of activism up until now, at least?
Yeah, no, definitely. What we're seeing is, since activists in the States are pretty much bumping into each other as they're pursuing the same companies, that shift in focus to Europe is definitely, if it hasn't already happened more so than now, it will in the next couple of years. But it's interesting, though, that activist investors there, they take a much different approach when dealing with their targets. For example, Sevian Capital employs a much more non-hostile way of speaking with management. So, in essence, they don't really publicize it as much as it's done in the States. So really, unless the activists want the public to know they're pushing an agenda to a specific company, we've learned that all the dealings are really kept under the radar and typically don't become public until after the change is actually made.
Okay.
I was just going to add, if you switch to Asia, we know that about roughly 25 companies there have been publicly subjected to activist demands. Actually, it's interesting, in June of this past year, the Japanese Prime Minister introduced a new corporate governance code this pretty much took the aim at shaking up boards by calling on companies to appoint outsiders. And I would say that because of the increase in U.S.-based activists in countries like Japan and South Korea, we believe pretty much homegrown funds will begin to emerge as they see the benefits of pushing these companies to unlock further shareholder value.
Okay, so interesting to see the growth in Europe and Asia. Dan, maybe you could jump in now and talk about activists working together, whether it's before a campaign or the kind of pile-on effect after a campaign starts.
Yeah, it's interesting. So what we do is we tier the activists. We tier them 1, 2, and 3, and the tiering is fairly linear, right? It's based on just how big they are, how many campaigns they have, along with some other metrics that we keep in house. And we see traditionally that there's this wolf pack effect, where one activist who has the reputation, so to speak. We see that there's the smaller Tier 3 activists that usually piggyback behind them. And then we also see the emergence of a couple of funds that are directed by activist engagement, too. So this goes hand in hand with a variety of academic research that has made the argument that activism is beneficial for the overall market. So I don't think it has that negative connotation, because it's becoming more and more of a mainstream investment strategy. So you see kind of the barometer being set by the Tier 1 and 2 activists and piggybacking, for lack of a better word, by the Tier 3s.
Okay. And then finally, Greg, I put down here, I don't know if this is even the right term for it, situation-specific vehicles, because Luma works in a kind of different way from a lot of hedge fund activists. That is, you don't sort of build a war chest and go out looking for targets, right? You do work in a different way?
Yeah, that's right. We sort of work in the other way, which is that we're looking for good investment opportunities where we think working with management or in some cases pushing management to do things differently can create value. And when we find those situations, we go out and raise money for that specific idea and into a special purpose vehicle, and that's becoming more common, I think, and more popular. There's a bunch of reasons from the manager's perspective that makes more sense and is attractive, and also from the underlying beneficial investor's perspective as well. So I think that's becoming more common. I don't know from a company's perspective that it frankly has much impact. Either way, you're dealing with an investor who has a thesis around your company and is interested in seeing you change the way you've been operating, and generally you've got to be responsive to that. And by the way, I would just add, because it's a little bit of my pet peeve. You can't think of these investors as your enemy. We've used, well, I didn't, but someone on this call, use these phrases of, how do you beat them? How do you defeat them? How do you know that they're coming? All this kind of thing. I mean, these are your owners. They're owners of the stock. They're no different than any other owner, except maybe that they've got a point of view they're willing to express. And these people should be thought of as your friends who are offering you free advice, unlike the investment bankers and lawyers that you pay a pretty penny for advice from.
Great point, Greg. Yeah, and I suppose we still have some old habits from when activists were the barbarians at the gate, right? But no doubt the theme underlying this whole event is working with activists, not against them. Well, listen, we have some time to take a few questions from the audience, and we've had some good ones come in. So let's start off. Here's one for John, and this is going back to your point about activists building stake using derivative swaps and other means. And the question is, what are the prospects for updated disclosure regulations in the face of activists' increased use of derivatives to establish positions in targeted companies?
Yeah, that point has actually been floated around the street. I would say more so this past year than any others. Specifically, with the whole ramping up kind of like the settlement versus trading process into a quicker time period. So instead of 3 days to settle, the SEC is looking into pushing it into 2 days to settle. In terms of derivatives, like Greg had said, I mean, it's the broker-dealers that are allowing, these hedge funds to basically anonymously kind of, for lack of a better word, hide, their stakes in companies, so that way they get around the whole disclosure laws. So really, I mean, unless, this is coming down from Washington, whereas, they say, look, no more of this, kind of along the lines of like, the naked short trading that we saw back in 08 or 09, this is still going to be, a viable investment kind of, way to amass stakes in companies.
This is Greg. Neil, if I may, this is Greg. I never suggested that brokers were allowing people to evade laws, and I don't think they do. We have a very antiquated disclosure system around 13D and 13F. And one might even ask why we have a 13D system, which I think would be a fair question. It was put in place, let's not forget, because of Saturday night special tender offers, which no longer exist. It was never intended for public market minority investors who were not looking to take over a company through a hostile tender offer back in the bad old days where there were two-step tender offers. So the whole notion that an investor with a point of view should have to disclose or should be treated differently than an investor who doesn't have a point of view, I think ought to be re-examined. I'm not sure why we have 13D at all. So I don't, it seems wholly unfair to me in the same way that, the uptick rule was unfair to short sellers.
All right, so kind of an anachronism. It's outdated. It's not needed, certainly in this activist environment. Greg, we have another.
Yeah, in the same way that Hart-Scott-Rodino is. Sorry, go ahead.
We have another good question from the audience, and this is for you, Greg. This is about seating a board member. The question is, does getting people on the board in isolation help you achieve your returns, or isn't it more about getting the board to make subsequent changes, whatever that change may be?
Yes, of course. It's always about getting the company to change its position with respect to either operating strategy or capital allocation, capital strategy, whatever it is. It's not about the board members themselves. But what we have found is if you can recruit great board members who have the right expertise and industry experience, they can get into that boardroom and influence the direction of the company by virtue of their stature or experience or perceived expertise. And so when we've been able to put former CEOs from the industry onto boards who have great track records and great experience, they've been able to help companies through a turnaround or make transitions that end up improving the operating performance of the business. So those are often the best board members. It's someone who brings fresh perspective and experience into the boardroom and can be persuasive when they're in the boardroom.
Okay, good point, Greg. Thank you. And Dan, another question from the audience. This one is for you, and this might not be something that you've considered. Maybe this could be something good to add to your to-do list in the next few months. So according to Activist Insight, 12.4% of the S&P 500 were targeted by activists in 2015. So was the 10% that you mentioned that are vulnerable additional to those already targeted? Are they the same? Have you had a chance to look at who were vulnerable and who actually did get targeted?
Yeah, absolutely. That's a great point, and I appreciate the chance to clarify. So, yeah, the model itself highlights about 10% of the S&P that's not highlighted. There is some overlap, right, but there's also a variety of companies within that mix. How many, I'm not necessarily sure off the top of my head, but there are some companies, we did double-check that have not yet had any sort of engagement. Okay, good.
And then maybe we could ask a good question that came in advance of the webinar. And Greg, maybe you could field this one. And this is about to do with buybacks. And the question is, a lot of companies are doing self-tenders as a way to return capital to investors. Is that a good way to kind of preemptively fend off activists, or is there a question of cost?
Well, I don't like the phrase "fend off" because you shouldn't be wanting to fend off people who want to buy your stock. You should love people who want to buy your stock; they're your friends. But if the question is a self-tender a good way to return capital to shareholders? The answer is it often is. The thing that investors generally like about them is they are relatively quick, and there is certainty around returning the capital to shareholders. And you generally get good pricing because the way you do a self-tender is often through a reverse Dutch auction process. So you essentially buy back the cheapest shares that you can get from your investors, and you get the money back quickly and retire the shares quickly. The downside to that process is there are sort of legal and banker expenses associated with it, whereas an open market buyback program, is cheaper on a per share basis. So those are the trade-offs. But you will see lots of activists call for a self-tender and get them as part of settlements because that way they know the capital will be returned by a date certain and the shares will be retired, as opposed to leaving it to the discretion of the CFO or a bank that they hire to buy stock when they see fit or when they regard it as attractive.
Yeah, I'll also add to that. I think it's a great point, but I think also it's important to take into context the holistic theme or the holistic vulnerability that your company is presenting to the market. So, for example, if there's a variety of vulnerabilities, there's 4 primary ones that we track, and I think if you're purely looking through terms of buyback will fend off. Excuse me, sorry, Craig. An activist will appease an activist. I think you have to look at the underlying vulnerabilities to begin with, because that might not be the most efficient use of capital, or might not, without you talking with the particular investor, that might not be what they consider the optimized deployment of that capital. So it's important to take into context what the underlying vulnerabilities are in the first place, rather than just focusing on, well, let's do a buyback, let's increase the dividend, let's do M&A. Just keep that into consideration.
Another great point, Dan. Listen, let's wrap up our webinar there, bring it to a conclusion. Dan Romito and John Isle from Nasdaq Corporate Solutions, thank you both very much for joining us on the webinar, and thanks especially to Greg Taxton from Spotlight Advisors and Luma Asset Management. Great talking to you all, gentlemen. Thanks to Nasdaq Corporate Solutions for sponsoring and working with us on this event. I recommend the white paper that we did together that Nasdaq sponsored. It's available from IR Magazine. We'll be emailing a link. It's chock full of good advice from the go-to advisors on both the activist and corporate sides. And thanks to our audience for listening, to our live audience for listening to the questions that came in. It's been a good webinar, and I thank you very much. Goodbye.